Bazaar Morning Call, live from the CNBC-TV18 headquarters in Mumbai.
Certainly not a very good quarter for Yes Bank, with gross NPA at 5.01% and net NPA at 2.91%.
It would be now fair to say that, our asset quality has stabilized.
Wipro reports a big miss in Q1 in terms of revenues. Dollar revenues have declined by 1.8% on a quarter-on-quarter basis.
We will see a little bit of spending getting faster. The demand environment is pretty good.
The entire process of resolution must be completed in 330 days. Besides this, descending financial creditors' position has been clear that even in the event of liquidation, they must get their dues as per the waterfall mechanism.
Okay, good morning. Welcome to Bazaar Morning Call. I'm Lata and with me is Sonia. Anuj has fallen victim to the epidemic of flu and viral that's spreading in the city of Mumbai. So we'll perhaps miss Anuj for today and maybe even tomorrow. But there's plenty of news to cover. We saw a little bit the Wipro results, the Yes Bank results and the IBC. Well, first up, the global markets are not giving us a very positive handover. Certainly not a positive handover for the bulls. Wall Street is worrying over earnings. All this while it has been pummeled higher because of tax cuts. Now that a cycle is probably beginning to slow down. So there are worries over there, and Asia too is down. Of course, there are the old trade worries and economic slowdown worries as well for the Asian countries. So, that handover is poor. And we've got domestic worries as well. Yes Bank numbers, we'll discuss that in detail. But there is a mix of both stressed assets and capital raising, which will bedevil that stock. Wipro and Mindtree, Wipro was a minor disappointment. Mindtree was a major disappointment. So all that is going to be fodder for the bears. The bulls have held on, not been able to make much progress over the 11,700 mark. The bankruptcy code amendments is a positive because it was a big bother that operational creditors were being brought on par with financial creditors, the bankers. As well, it was taking forever. SR is now, 700, 800 days in resolution. So there is a time ceiling put over there. All that is general good health for the corporate sector. It's not enough to give bulls a fodder right now. They can't snatch the initiative right away. Yes, crude is also a little bit of a positive, but since it is also a victim of slowdown, I'm not sure today bulls will have enough to bounce.
Okay, Lata, hi, good morning. And we've already seen 3 days of a run-up, right?
Exactly.
I mean, the Nifty gained for the third straight day yesterday. Just a couple of levels to watch out for. A lot of our technical analysts have indicated that the 20 and the 50-day moving average now will be keenly watched. The 20 DMA is at 11,733 and the 50 DMA at 11,711. So that could prove to be a bit of a hurdle for the market. The positive is that FI selling has reduced. So yesterday we saw about 17 crores of selling from FIIs. On an average, it's been about 500 crores of selling in the last 6 trading sessions. So that's a positive. Also, domestic institutions have continued to buy. So about 200 crores are there. Brent is now below $64. So that's also a positive. But having said that, the weak earnings from Yes Bank, Wipro and Mindtree will definitely have a sentiment impact. On Yes Bank, of course, we discussed how, the below investment grade book has risen quite a bit. It's gone from 7.1 to 9.4% of corporate book. But on Mindtree, I just want to mention, it's a 500 basis points quarter-on-quarter cut in margins. And they've scaled down their FY20 guidance. So, that just goes to show that the larger guys are facing a problem, yes, like TCS, but the smaller guys are also getting hit very hard.
Yeah, this time the earnings season for IT has been a very mixed bag, with some people being able to weather the worries better. And of course, there are idiosyncratic problems as well for Mindtree. My sense is that Bank Nifty may give a bit of succor today. Cheaper crude means, again, a positive for yields and inflation. Banks are going to really harvest this quarter. If the bond yields continue the way they are, banks will make a very good packet on their treasury book. Their bonds will be, like a good 10%, 20% higher in value, MTM gains. So there is that for the banks, and this IBC bankruptcy code corrections, recoding of the bankruptcy code should be positive. So let's hope that that is the positive for the bulls while the rest of the market worries them.
But you know what you said initially makes sense because the SGX Nifty is indicating the start will be in the red. So after 3 days of gains, perhaps all of the negatives will play a bit catch up to the market, especially the negative data points in terms of earnings. But let's take a look at what our wise experts have to say, and then we'll discuss all of these cues in greater detail. First up, Mahesh Nandurkar of CLSA says the US-China trade issues have driven several exporters away from China, but India does not seem to have benefited yet, since most manufacturers have decided to move to destinations such as Taiwan, Vietnam and Mexico. Significantly high corporate taxes and India's perceived red tapeism are probably outweighing the attraction of India's large domestic market. United Phosphorus remains the only company under their coverage that clearly benefits from continued US-China trade issues.
Oh, okay. UBS was saying that they are seeing some shift of companies. We had chatted with their head of research and strategy some time back. But, okay, this is not looking like a very positive note from CLSA. Let's get you money market views. Bhaskar Panda of HDFC Bank says the rupee came under pressure yesterday and today we might see consolidation. Trading range for the day seen at 68.65 to 68.90.
And on the bonds, Bhaskar Panda says they are experiencing bullish undercurrents on low inflation and further rate cut hopes. The 10-year benchmark yield has broken through various resistances and closed around 6.34% yesterday. We discussed that. He expects to see some consolidation today within 6.3 to 6.4%.
Okay, well, that's how the domestic cues are piled up. How are the global cues piled up? Nigel is here for the world view.
Well, the U.S. markets ended in the red in the overnight trading session. There is fear now, in fact, that trade deal between the United States and China, that may not come about post the statements that came in from President Trump. Now, in overnight session, Huawei was the one that was, the restrictions on Huawei, that could be one of the reasons why the deal progress could get stalled. And if we're looking at stocks, and earnings was back in focus in yesterday's trading session. You had Bank of America, those numbers look better than estimate. The stock ended mildly higher. CSX, that's the roll rate major out there, that was down nearly around 10%. And all roll and rail stocks yesterday were under some pressure. And besides that, you had United Airlines. The numbers look better. They've increased their buyback as well. The stock ended higher. While Cintas as well, that's the first aid kit maker, that as well was higher in yesterday's trading session. So more beats than misses. In terms of economic data coming out of the United States, the housing data was weaker than expected. The housing starts, in fact, that showed a bit of a degrowth, which wasn't very great news. But that's fueling expectations that the Fed will go ahead and, in fact, ease interest rates in the time to come. European markets, well, they were under pressure in yesterday's trading session. You had a couple of data points coming out of there. The inflation numbers that came in, well, that was mildly better than what the street was working with, yet it's lower than the 2% target. And, because these equity markets ended in the red, you had some buying in precious metals. So gold continued to move higher. You had silver as well, that's at a 4-month high. So both those two moved higher in the overnight trading session. This morning, though, the cues coming in from Asian markets, not that great. You had the exports data coming in from Japan, that missed estimates. And you had Bank of Korea that went ahead and eased interest rates. Asian markets should come up for you on the screen, most of them trading in the red. The SGX Nifty as well, indicating a bit of a softish start. Back to you.
No, absolutely. In fact, the Japanese market is now down almost 350 points. So quite a bit of pressure is what you're seeing across most of the Asian markets this morning. Thanks, Nigel, for that. But as trade tensions resurface, the IMF says that global trade growth has been slowing as a result of tensions between the United States and China and others. The IMF chief economist Geeta Gopinath says the US-China trade war could shave 0.5% of global economic growth in 2020. That's quite a bit. Listen in.
The main short-term risks stem from an intensification of trade tensions or a disorderly Brexit, which can have negative implications for global demand and global risk appetite, which then in turn can affect economies that are highly dependent on foreign demand and on external finance. Over the medium term, in the absence of corrective policies, trade tensions could become entrenched, and a further widening of stock imbalances could trigger disruptive adjustments in key debtor economies that could then spill over to the rest of the world. It is imperative that all countries avoid policies that distort trade. Recent bilateral trade actions have had no discernible impact on the global imbalances, as external imbalances reflect macro policies that affect aggregate saving and investment. Instead, higher tariffs have been associated with increased prices for consumers and are weighing on global trade, investment and growth, including by eroding confidence and disrupting global supply chains. We estimated that if you take into account the tariffs that were put in place in 2018 between the US and China, and then include the tariffs that were threatened in May between, again, the US and China, then that would reduce the level of global GDP in 2020 by 0.5%. So that's what we'd estimated. So this is a significant cost to the global economy, and at a time when global trade is already very weak and investment is weak in the world.
Okay, so that's the added worry which is keeping across Asia and the developed markets a positive for the bears because global trade is likely to shave off about 0.5% according to IMF from global economy. We take a quick break on that note, but we have plenty of stocks to discuss and big ones at that, which announced numbers after market hours yesterday. We are back in jiffy.
Entire budget